Hi everyone and welcome to another episode of Beyond the Trade. My name is Christophe Rilinger and today I'm joined by Jutta Frey-Hartenberger, Global Product Lead here at Eurex. Jutta, welcome to Beyond the Trade.
Thank you, Christophe.
In today's episode we're going to discuss the new EU bond futures and see what the impact is on the European interest rates landscape. Let's get started with the key questions. What is actually the EU bond futures? What are they accomplishing and why are they so important to you?
The EU bond futures are a standardized hedging tool backed by the AAA rating of the EU as an issuer. So far, other future contracts or other market elements like swaps have been used to hedge EU exposure. Now we have a dedicated product which provides efficiency and more tailor-made hedge opportunities.
Now let's look at the rationale behind the launch. What was the reason why Eurex launched this product now? Is there a specific reason?
The EU bond market matured over the last years. So now we have over 650 billion euro outstanding on debt, with the EU being the fifth biggest issuer in Europe. Over the last 2 years, they developed a own yield curve. They created a liquid secondary market, and since 2024 they are also a member of Eurex Repo. That all together is now offering a framework which allows the launch of a product really to focus on this asset class or that issuer, which is a new kid on the block.
Yeah, and I think you mentioned it already, but what's really the trigger behind the new EU bond issuance?
The trigger was definitely COVID-19. So in 2020, the member states of the EU joined forces and decided to launch two programs. There was the SURE program on one side, where they started the launch in 2020. That was to fund unemployment, followed by the Next Generation EU program, where the issuance started in 2021. The overall issuance policy was pulled together under the so-called unified funding approach in 2023. So with that, you have a huge transparency of the EU bond issuance and a big marketplace, which is covering a lot of market needs and investor groups, not only in Europe, but also international. And here we kind of enrich the toolkits of investors and natural users by a dedicated futures product.
So I guess thanks to COVID.
Kind of, yes, indeed.
Now let's dive a little bit deeper. What makes these futures really appealing?
Well, I think it's definitely the case that they are on one side tailor-made on the EU debt with its AAA rating. On the other side, they follow the existing standards of our fixed income futures, which allows the product to be used without any big building or implementation effort. It is kind of a standardized plug-and-play product, only on a different underlying. So you have the same patterns, we use the same methodologies on pricing, etc. And additionally, we support the product with a liquidity provider scheme to ensure transparency and hopefully grow volumes in very soon time frame.
You mentioned the existing products, the Bund and OAT. To what extent do they actually compete?
I wouldn't say it's competing. I would rather say this product launch is complementary to our existing fixed income suites. So while the Bund and the OAT, as we have it now, are futures on national sovereign debt, the EU is more an SSA character. So you have a difference here. But as I mentioned before, the standards are the same. So they follow the same methodology and everything. You just have an additional tool to improve hedging efficiency and to reflect properly the European capital market with those big issuer are covered with our existing fixed income futures suite.
So more opportunities for our customers.
Definitely.
And what about another part, the liquidity? You know, when I mentioned these opportunities, this comes with liquidity. What about that?
Liquidity is a key element for the launch. So we have a liquidity provider scheme that supports liquidity. This means that there are dedicated liquidity providers who are streaming prices into the order book. It is very important for the market to see tight and transparent pricing to have a solid and robust order book, which creates more credibility and the market relying on that new product to be used more frequently and then build up more volumes over the time.
What's the expectations you have and has been the market feedback so far?
Market feedback has been very positive. So we definitely see that this new futures product on the EU debt is another core instrument that's going to be used for hedging any European interest rate exposures. So I think you can really say it is complementary but not competitive to the existing fixed income offer of Eurex, including OTC, including repo market, etc.
Now, switching gears in terms of trading style, you're expecting more on-screen, like for the traditional futures we have right now, or more off-screen?
I would say we will probably see the same patterns we already see for existing fixed income futures. That means that, similar to the others, the product allows trading in the order book, but also execution against our trade entry service functionalities. So this means you can do block trades, you can create basis trades, what we call exchange for physicals, and you can trade it against the swap market with our exchange for swaps facility. Looking at the average ratios for the fixed income futures, we see about 90% of the volumes being traded in the order book, while on average 10% plus minus a few are trading via our test functionalities, and I expect the same patterns to see for the EU bond futures.
Let's talk about the growth drivers, right? So you're expecting this more new entrants or the traditional players to be the major partners of this new product?
Both. So we definitely see the major players. They are also supporting the product in general. A lot of those traditional players are investment banks who are also primary dealers for the bonds. So they are a natural group of users being a primary dealer for the underlying cash market. We have the already existing investors into the current EU bonds. However, the EU as an issuer has still that hybrid character between SSA and EGB. So they are not a full sovereign nation who is issuing, but they still have that supranational character. Having said that, this will most likely twist some more interest from SSA desks to move into the futures. And with this, the overall market dynamics may change with new joiners on the future market.
Now let's wrap this up. One question, very important, the cross-margin aspect, right? Capital efficiencies. What can we expect there?
We can expect the same offer we currently have for our fixed income futures. So what does it mean? The EU bond futures are in the same liquidation group, and this allows to have a cost-efficient portfolio margining via our Eurex Prisma.
Well, thank you very much, Jutta, for joining us and
Welcome.
for being here and sharing your expertise. And to our viewers, thank you for watching, and tune in as we go next time beyond the trade.